Today I am going to explain you the preparation of journal entries, and the rules followed for journal entries will be based on accounting equation, and the rules are: rule 1, debit when assets increase, credit when assets decrease. Rule 2, credit when liabilities increase, debit when liabilities decrease. Rule 3, debit all expenses and losses, credit all revenue and gains. Now, on the basis of these rules, I will prepare certain basic journal entries so that with the help of those you will be able to understand the principles of making journal entries, and later on you will be able to make complicated entries on your own also. Okay, so let us start. First is, Ram started business with cash. Okay, I am not going to write the amounts because that won't serve the purpose. We just want to know which account is to be debited and which account is to be credited. Now, Ram starts business with cash. Now, in this case, two accounts are involved. One, cash, and other, Ram's account. Now, cash account is an asset, and the rule for assets is debit when assets increase, hence, and credit when assets decrease. In this case, cash is increasing, hence cash account will be debited. And Ram's account, which is actually the capital account, he being the proprietor of the firm, his account is increasing. Capital is again a kind of liability for the firm, hence capital account is increasing, it will be credited. So what will be our journal entry in this case? Cash account debited to capital account, that means capital account credited. Cash account debited to capital account. Now our second journal entry is cash deposited in the bank. Now if you deposit cash in the bank, you are going to reduce cash with yourself, and cash in the bank will increase. Both accounts, cash and bank, are assets account. So cash is decreasing. So cash will be credited. Since bank is increasing, bank will be debited. Bank is increasing, hence this rule. So our journal entry will be bank account debited to cash account. Bank account debited to cash account. Third entry is purchased furniture with cash. Now again in this case, both accounts are assets account, furniture as well as cash. Since we are buying furniture, furniture is increasing, so furniture account will be debited. And since cash is decreasing, cash account will be credited, because our rule is debit when assets increase and credit when assets decrease. So our journal entry in this case will be furniture account debited to cash account. And next journal entry is about purchasing goods. Now, when we buy goods for our business, now that is debited to purchase account, and purchase account is an expense account, and rule for expenses is debit all expenses, hence purchase account will be debited. Since we are paying cash for our purchases and cash is reducing, cash account will be credited, that is credit when assets decrease, hence cash will be credited. Entry will be purchase account debited to cash account. Next is purchased goods from Shyam on credit. Now again we are buying goods. as you know, purchase account is an expense account, and the rule for expenses is debit all expenses. Again, purchase will be debited. But in this case, we are buying on credit from Shyam, and that means liability is increasing, and the rule for liabilities is credit when liabilities increase. So in this case, Shyam's account is increasing, so Shyam's account will be credited. So what will be our journal entry for this case? Purchase account debited to Shyam account. Purchase account debited to Shyam account. Okay. Next is sold goods for cash. Now in this case, sales account. Sales account is a revenue account, and rule for this is credit all revenues and gains. Hence, sales will be credited. Since we have sold goods on cash, cash is coming in, cash is increasing, hence cash will be debited. Rule being debit when assets increase. So our journal entry in this case will be cash account debited to sales account, that is sales account credited. Cash account debited to sales account. Our next entry is sold goods to Naresh on credit. Okay. Now in this case, again sales account is involved. Since we have sold, and sales account, as you know, is a revenue account, and the rule is credit all revenues and gains. Hence sales account will be credited. Okay. But we have sold it on credit to Naresh. Now Naresh account is an asset for us, because later on we have to receive money for goods sold to him. So Naresh account is now an asset for us, and the rule for assets is debit when assets increase. So in this case, Naresh account will be debited and sales account will be credited. To sales account. Our next entry is returned goods to Shyam. You know, it happens in business. Sometimes because of various reasons, maybe goods are not up to mark, or we don't require them, or whatever the reason. Sometimes whatever we buy, we return back. This is called, because this was earlier because it was purchases, now we are returning it, it is purchase return account. Since purchases was an expense, so purchase return should be reduction of expense account. So the rule for expenses is debit all expenses. That is debit all expenses when they are incurred. Okay. So if expenses reduce, we bought goods. When we bought goods, we debited purchase account. Now we are returning it. Naturally, we should credit the purchase return account. Okay. So in this case, we are returning it to Shyam. Okay. And Shyam was our liability. We had bought from him goods on credit. Since we are returning goods, our liability towards Shyam is decreasing. Okay. And the rule for liabilities is debit when liabilities decrease. Hence, Shyam account will be debited, because now our liability towards Shyam is decreasing. So Shyam account will be debited and purchase return account will be credited. Shyam account debited to purchase return. Now you can well imagine, if some people who have bought goods from us on credit return to us, what will be the entry for that? For example, the person to whom we sold goods has returned. That means earlier we had credited those amounts to sales account. Now if goods are coming back, sales return account should be debited because earlier sales was credited. Now in this case, if somebody returns goods to us, sales return account will be debited, and the person to whom we had sold goods on credit was actually our debtor. Right? Now debtor is an asset account. Now since he is returning goods to us, his account will reduce. So when assets reduce, they are credited. Debit when assets increase, credit when assets decrease. Hence in this case, the person who is returning goods to us will be credited. For example, if goods are returned by Naresh, our entry should be sales return account debited to Naresh account. Sales returns account debited to Naresh. Now, if we make payment of rent through check, in this case, we are paying rent. Rent is an expense account, and for expenses, the rule is debit all expenses whenever they are incurred. So, if we are paying rent, then rent account will be debited. Since we are paying through the check, our bank account is decreasing, and bank account being an asset, rule applied will be credit when assets decrease. So what will be our entry now? Our entry will be rent account debited to bank account. Rent account debited to bank account. And next entry is received interest from bank. Now when bank pays us interest, it credits to our account itself. So because of this, our bank account is increasing. So when bank account is increasing, bank being an asset account, it will be debited. And since we have received an income and on account of interest, the rule for that is credit revenues whenever we receive them. So in this account, the interest will be credited. So entry will be bank account debited to interest account. Bank account debited to interest account. Our next entry is paid Shyam. For example, we owe to Shyam 5,000 rupees. While making the payment, he gives us a cash discount of say 500. Naturally, we will be making a payment of 4,500 and 5,000 he will give us discount, and our liability of 5,000 will be settled. Okay? In this case, just see how the entry is formed. What are the accounts involved in this? One, Shyam account, whom we owed 5,000. 5,000 liabilities being settled, and when liabilities reduce, they are, what is the rule for liabilities? Debit when liabilities decrease. So our liability to Shyam is decreasing. So Shyam account will be debited. Let us see how it goes. Shyam account debited 5,000. And see, since we have paid only 4,500 to him, so our cash is reducing by only 4,500. So cash being an asset account, when it is reducing, it will be credited. So cash account will be credited by 4,500 only to cash account 4,500. Now what about the difference of 500? This is the amount of discount earned by us. This is the amount of discount earned by us. Hence, discount is a gain for us, and the rule is credit all revenues and gains. Hence, discount received account will be credited 500. You must notice that the total of debit side is 5,000 and the credit side's total is also 5,000. Both sides are equal. Now you see in this entry is special one in the sense that it involves more than 2 accounts. Now wherever more than 2 accounts are involved in a journal entry, that entry is called compound entry. Okay? I'll give you another example of compound entry. For example, on a particular day, on a single day, if 2 or 3 or more entries are done of the same type, we can make a single journal entry for that also. For example, on a particular day we pay rent, we pay interest, we may pay salary. For all these things, we can make a single journal entry. For example, if we pay rent, so rent account will be debited. Say we pay 1,000 rupees, and if we pay interest also 500 rupees, and for example if we pay salary also, so salary account will be debited say 3,000. If all the amounts, say 3,000 plus 4,500, 4,500 is paid through cash, so our cash is reducing only by 4,500, so cash account will be credited by 4,500 to cash account 4,500. Now this is again an example of compound entry. This is again a compound entry. Okay? Now, for example, this is a case where we have received discount. For example, if somebody pays us before date, we may also allow some cash discount. In this case, what kind of an entry will be made? Let us see that. For example, Mr. B, who owes us 2,000 rupees, and we allow him 10% discount on his making payment to us. So actually he will be making a payment of only 1,800 rupees, and we will be allowing him a discount of 200 rupees, and our asset will reduce by 2,000. Asset is that Mr. A's account. A's account will reduce by 2,000. Hence A will be credited by 2,000. Rule being credit when assets decrease. So our asset, that is our debtor, is reducing, and we are receiving a discount of, we are receiving cash of 1,800 and allowing him a discount of 200. In this case, since our cash is increasing, cash account will be debited by 1,800 and 200 being discount allowed by us, and discount allowed by us is an expense, hence all expenses are debited. So discount allowed account will be debited. Discount allowed account debited 200 to A's account. A's account will be credited by 2,000 because our asset has reduced by 2,000. Asset was debtor. This is again a compound entry. Okay. Next entry is purchase goods from Gopal, who allowed 10% trade discount. Now, do you know the meaning of trade discount? See, there is a difference between cash discount and trade discount. This you must understand. What is the difference between trade discount and cash discount? You see, trade discount is allowed by traders or sellers to induce us to buy more goods. For example, if somebody is offering a shirt for say 500, he may say, if you buy 2 shirts, I will give you 900 rupees. So he is allowing us a discount of 100 rupees. Now this is a trade discount. He is inducing us to buy more goods at the same time. And you know, cash discount is when somebody induces us to pay before date. For example, somebody allows us debt of 2 months. Okay, but he says, okay, if you pay me before 2 months, I will give you a discount of 5%. And if we are to pay him 1000 rupees, he will give us a discount of 5%, that is 50 rupees. Now, this is a financial charge. This will enter our entries as you have seen earlier. But trade discount is different from this. This never enters our books. For example, if I am buying something which is valued at 1000 rupees, you see, and the seller allows me a discount of 10% and he gives it me for 900 rupees, then entry made will be only for 900 rupees and not for 1000 rupees, not for 1000 rupees. Okay, let us see. Purchases account debited 900 to cash account 900. Though goods were actually worth 1000 rupees, but he allowed us a discount of 10%, that is 100 rupees. So 1000 minus 100, 900. So entry will be made only for 900 rupees and not for 1000 rupees. This is all about trade discount. Trade discount never enters our journal entry, but the other discount, which is cash discount, that always enters our books. Okay, right. Now our next entry is, for example, if somebody goes bankrupt, you know the meaning of bankrupt? That he is not able to meet his financial liabilities. It can happen, and in this case we have to write off his account with us. For example, if Naresh owed us 1000 rupees and he goes bankrupt and he does not pay us anything, ultimately it's a loss to us. Now we have to bring this loss into our books. So rule for this is all debit, all expense and losses. And this kind of a loss where our debtors are not able to pay us, that loss is called bad debts. So in this case, bad debts will be debited. All expenses and losses are debited. Since Naresh, who was our debtor, was an asset account, since now that is reducing, okay, so rule for that will be credit when assets decrease. So our entry will be bad debts account debited to Naresh account. Now in this case, you know what has happened? We have charged our account, we have charged 1000 rupees to our expenses account, that is bad debt account, and we have reduced Naresh account by 1000 rupees. Okay? Now, sometimes what can happen is that all certain bad debts which we have already written off, people may pay us. Okay? So in this case, what will happen? We will receive cash or bank, both are our assets. If we receive cash, then cash account will be debited, and if we receive check, bank account will be debited. But which account will be credited? Here the point is, since we have already written off the account of our debtor, it won't be okay to credit our debtor's account. We shall credit another account which is called bad debts recovered account. It is why we are crediting this account. We are crediting this account because bad debt recovered account is a revenue account. It's a gain. The rule for this is credit all revenues and gains. For example, Mr. Naresh, whom we had written off 1000 rupees earlier, gives us say 300 rupees back. So the entry for that will be cash account debited. Now cash account is being debited because cash is increasing to bad debts recovered account, this being our income account, this is being credited. This is the rule for this. Credit all revenues and gains. Okay? So our next entry is cash withdrawn or goods withdrawn by the proprietor. It can happen, the proprietor can go on withdrawing on monthly basis or maybe quarterly, whatever his way. So whenever he makes any drawings from the firm, whether in the shape of goods or in the shape of cash, we have to debit drawings account. Otherwise, if we were not to debit his drawings account, we would have debited his capital account, because this is a liability account for his capital account. So rule for liabilities is credit when liabilities increase and debit when liabilities decrease. So if the proprietor withdraws from the firm goods or cash, his capital is reducing. So we could debit his capital account. But instead of debiting his capital account again and again, we debit the drawings account, which is ultimately close to the capital account at the end of the year. We keep this account separate so as to make analysis when how much was withdrawn. Okay? So in this case, if he withdraws cash, our cash is reducing, so cash account will be credited. And since his capital account was to be debited, since our liability is reducing, or instead of capital account, we are debiting the drawings account. So entry will be drawings account debited to cash account. If he had withdrawn through bank, say through check, bank account would have been credited. Okay? But if he withdraws goods, then our entry will be drawings account debited. You know why drawings account is being debited, because as I have explained in this, it's our capital account, and drawing account is a part of capital account in a way. So, and capital is reducing, so that's why drawings account is being debited. Now, but which account will be credited? Whether sales account or purchase account? You see, purchase account will be credited here, because when we bought goods, we debited the purchase account. That is an expense account. Okay? So, one cannot make profit from himself. So in this case, he has withdrawn, say, goods worth 5,000, which was bought for 5,000. So purchase account will be credited by 5,000 and not sales account. Because earlier when goods were bought, they were debited to purchase account. So drawings account debited to purchase account. Sometimes, goods are given as charity also. From the business itself, the goods are given as charity, and sometimes are given as free samples. What will be the entries for them? Let us discuss them. For example, if somebody has given his goods from the business for charity. Now charity being an expense, debit all expenses, so charity account will be debited in this case. Charity account will be debited, this being an expense account. Again, goods have gone out from the business, right? Goods have gone out of business, and when we had bought goods, we had debited purchase account being an expense account. Now expenses are reducing on account of purchases, because we have used goods for the purpose of charity. Hence, purchases account will be credited. Similarly, if we have given goods from our business as free samples, now naturally we give free samples for advertisement of our business. So in this case, advertisement account will be debited, or advertising account will be debited, that being an expense for the firm. So rule for expenses is debit all expenses. So in this case, advertising account will be debited and purchase account will be credited. I have given explanation why purchases will be credited, similar to this. Okay. Now again we can have another entry for, sometimes whenever we are installing a machinery in the factory, or we are sometimes with our own resources make some building in our factory or in our showroom, we make something. For example, whenever we buy machinery, we may create a platform for it, we may do some wiring for it. While bringing the machinery to our premises, we might have paid some freight, etc. What has to be done in this case? Remember one thing, all the expenses paid by you for bringing the machinery to your premises, like freight, octroi, or all the taxes, all will be debited to machinery account. Because that means in technical language we call all those expenses will be capitalized. This being an asset, machinery. So all those expenses which we have spent for the purpose of bringing the machinery to our factory will be debited to machinery account. Similarly, all the expenses which we incur in our factory to install the machinery, like making a platform for it, wiring, etc., to bring it in the operational form, all expenses will not be debited to respective expenses, but will be debited to machinery account. For example, we engaged our workers for the purpose of installing this machine. So wages paid to them will not be debited to wages account, but will be debited to machinery account. If we have taken certain materials from our factory for the purpose of installation, again those expenses will be debited to machinery account, right? And not to expenses account from which we have taken. So in this case the entry will be machinery account debited to cash. Now this cash you might have paid for buying the machinery, or for paying for freight, paying for taxes, whatever insurance, etc. you paid for it, and all the expenses which you paid for its installation, maybe wages, etc. Whatever you paid for it should be debited to machinery account. Okay. Similarly, if you're you have set up a small shed in your factory, all those expenses which you have spent on that, all will be debited to building account and not to respective heads. For example, your own factory's workers have made the shed and you have taken cement, etc. from your factory. All the material you have taken from your factory for the purpose of making this shed. In this case, the entry will be machinery account, building account debited. This account is debited because an asset has come into being, an asset has increased, that's why building account is being debited. And since we have not paid anything in cash, we have taken materials from our own stores. So those materials when were bought were debited to purchase account. Hence here purchase account will be credited. For example, you have used the material worth say 10,000 you have taken from the stores. So you will credit the purchase account by 10,000. And you have employed your own workforce for which you have paid 3,000 as wages, and those wages have already been debited to wages account. Now, since those wages are used for the purpose of making this building, will be debited to building, hence they will be taken out from wages account. So what is the rule for expenses? Debit all expenses when they are incurred, and when they decrease, they are credited. Hence, in this case again, this account, wages account, will be credited. So 15,000 will be debited to building account. Again, it is a compound entry. Now, there are certain entries which are mostly made at the end of the year. That is for prepaid expenses. Now, you know what are prepaid expenses? Prepaid expenses are those expenses which we have paid for the accounting period, which is going to be the next year for us. I mean, which we have paid beyond this accounting year. For example, you have got insurance done in the month of, say, January. On 1st January, you got insurance done for, say, a period of 1 year, for a period of 12 months. And your accounting period is from 1st April to 31st March. For example, your accounting period is 1st April 2012 to 31/3/13. Okay? And you got your insurance done on, say, 1/1/12, or you can say 1/1/13. Now you see, this insurance is going to run for 12 months starting from 1st January, but this accounting period is going to end on 31/3/13. So that means this insurance will be useful for this accounting period only for 3 months, January, February and March. And for 9 months you have paid for the next accounting period, that is 13/14. If you have paid, say, 12,000, so out of that 12,000, 3,000 is for 12/13 and 9,000 is for 13/14, since you have made payment for this. So in this case, for example, if you made the payment, when you made the payment, you made this entry: insurance account debited to bank, say 12,000. Now in this case, insurance account has been debited, since insurance is an expense. Okay? And you have credited bank because you paid through bank, your bank has reduced. Now, if you look at it, on 31/3/13, you have spent only 3,000 out of it, 9,000 still pertains to next period. Hence, you have to reduce your insurance expense by 9,000. And prepaid insurance is an asset for you because you have paid for the next period in advance. So on 31/3/13, 9,000 is an asset for you. That is prepaid insurance. So when assets increase, they are debited. Your entry will be prepaid insurance account debited 9,000 to insurance account 9,000. I will tell you the reason again for this. Prepaid insurance has been debited because prepaid insurance is our asset as on 31/3/13, because for 9 months we have paid in advance, and insurance is being credited because insurance was booked as 12,000, it was an expense, so we have to reduce our expenses by 9,000. So when expenses are to be reduced, they are debited. Credit all revenues, debit all expenses when they are incurred, and when they reduce, they are credited. That's why insurance is being credited. Now I will tell you about outstanding expenses. Now at the year end, sometimes we feel that we find that we have not paid for certain things. For example, salary, rent, anything, any business expenses could be. But we write our books on accrual basis. Accrual basis means what? that we recognize all the expenses and incomes on the basis of whether we have utilized the facilities or not. Okay, for example, if we have used the services of our employees and we have not paid them at the year end, say for 1 month, now this expense belongs to this year, but we have not paid for it. So according to accrual principle, we must book this expense in our books. Okay, and we must create a liability towards our employees. Okay, so for this the journal entry will be salaries account debited to outstanding salaries account. Now salaries account is being debited because salary being an expense, the rule is whenever expenses are incurred they are debited, so salary account is being debited, but at the same time we have not paid for it. It's a liability. So rule for liabilities is credit when liabilities increase. Credit when liabilities increase. So in this case, outstanding salaries is an liability account. It is being credited. If you have not paid rent, for example, your entry will be rent account debited to outstanding rent account. Okay? So I think you have understood this. Another entry I am going to tell you, and that is for depreciation. You know what is depreciation? Depreciation is reduction in the value of fixed asset because of usage, etc. Maybe they become obsolete also, but mainly because of usage. For example, if I buy a machinery for 10,000 rupees and the estimated life of this machinery is 5 years, and if I go by straight line method, so naturally it means every year my machinery will reduce by 2,000 rupees. Okay, now 2,000 reduction in the value of my machinery has to be booked. It is an expense for me, and that expense is called depreciation. Now in this transaction, I have incurred an expense of 2,000, and at the same time my machinery has also reduced by 2,000 in value. Both the aspects I have to book here. And when my machinery reduces, so I will credit my machinery account, rule being credit when assets decrease. So in this case the entry will be depreciation account debited to machinery account. Say 2,000 rupees. This was bought for say 10,000, estimated life is 5,000, and at the period of 5 years if it is worth nil. So that means 2,000 depreciation is happening every year and it should be booked. And depreciation being an expense is being debited, and since my machinery is reducing, machinery being an asset, when reduces will be credited. I hope you find it interesting, and I hope you will make full use of it. And in my next lecture, I will be telling you about the posting in the ledger and preparation of trial balance. Thank you.